So, all right. Well, I appreciate everyone taking the time to come to the webinar today. Another exciting topic about the blueprint to buy your first apartment complex. As some may or may not know, my name is Cudjoe-Virgil. Our company is called Merlin Acquisitions, primarily based in Baltimore, Maryland, focused on value add B and C class properties. This is where our primary portfolio is based. And, we enjoy investing in multifamily. It's a great asset class. And today's topic is obviously going to be about the how to get started in multifamily, the blueprint to get started in multifamily. So whether you're active or passive, I think it's a great topic to touch on, to kind of get a feel of how to get that first deal done. So if you're passive, we have a join our investor group section on our website where you can just go in, fill things out. If you're a passive investor and you're interested in just putting your money to work, would love to chat and talk more about that. So let me turn my screen to today's slides here. All right. 1 second. Pop it up. All right. So the blueprint to buy your first apartment building, right? I think a lot of investors are starting to figure out that multifamily is the more scalable aspect to it, but the challenge is that there's a lot of steps that someone needs to take and really needs to focus on to actually get to that first deal. And in order to get there, you really have to kind of focus on it from a step-by-step basis, which is what I did when I first started in this space. And I wanted to break it down because it's a digestible approach as to where you want to focus on and where you think you should be focusing on. Because the truth is, when you're trying to scale and do bigger deals, it requires more and more manpower, right? More and more resources, human capital to get that done. And you really have to understand the importance of you having a good knowledge at different phases within the process to get your first deal, because it's easy to kind of get lost and kind of get frustrated, right? So we're going to be talking about that in detail. And my hopes is that this will be a blueprint. When I wanted to do my first deal, I had these steps laid out on my wall. And like people already say all the time, right? Out of sight, out of mind. I wanted to make sure that I'm focusing every single day on these particular steps to get the first deal done. Back when I started a couple of years ago. So, all right. Let's go to the next slide. So we talked a little bit about me and my background. And so, the frustration is real for a lot of people, right? When they're trying to get into the world of multifamily, when they're trying to get into bigger deals. And the reality is that, apartment transactions are much bigger deals, more moving parts, and you have to deal with a lot of different people in the process. And generally, there are two reasons why people don't get to do their first deal. It's either they can't find the deal or they can't raise the money, right? Those are the two things that directly correlate with your ability to do the deal. Of course, you have to have the expertise, but if you can't find a deal and you can't raise the money, then it gets pretty frustrating. So I've outlined an 11-step acquisition plan that I wanted to go through that I'm 99.99% sure that breaking this process down will help you figure out from a detailed perspective, from a process-oriented perspective of what you need to do and what you need to focus on to get that first deal done. All right, so the first step, right? Defining your criteria, extremely important here, because when I first started, I was burning a lot of time on like figuring out what's that foundational core asset that I'm going to go chase after, right? And you really have to narrow down your specific criteria, because your marketing strategies of how you're going to get those deals change, dramatically, right? If I'm looking at maybe a 10 to 40 unit range, I'm probably going to see a lot of mom and pop opportunities. Maybe that wholesale type of marketing, letters, those types of marketing strategies would work on the smaller unit count. But on the larger unit count, your 50s, your 75, your 100 plus units, those typically don't work. You're going to just send those to the gatekeeper. They're going to look at it, throw it away, right? So that's when broker relationships come into play. So you definitely have to know exactly what your criteria is. So an example criteria, 5 to 50 units, maybe a B and C class, asset class. You want non-recourse debt. You want to focus on, this price range, 1 million to 6.5 million, because this is what you think you can get a deal done within your market. Your location might be a mid-Atlantic market because you feel really good about the job growth and population growth. And the structure you might want to do, maybe you have just a friends and family, money that you can tap into, and it just might be worth it to just do a joint venture and lower the costs as opposed to a syndication. So this part is really, really important, because especially when you're new and a broker is vetting you out, you want to be able to have that elevator pitch, right? And you want to be able to have the ability to talk in the most the most astute way possible to put you in a situation where the broker is going to start sending you deals. So it's all about reputation, in this business, and focusing on your criteria is the very, very first thing you want to do. So the second thing is just developing that all-star team, right? So now you focused on the criteria. Now you have to figure out, what are the key players I need on my team to actually get a deal done. And business is a team sport, and real estate is no exception, right? And so in this business, really, you're only as good as your team, right? To do large deals, you have to assemble a bigger team, which is going to position yourself to submit offers, which is going to position yourself to, ultimately, have your investors trust you to close the deal and execute on the transaction. So team members, right? First thing, a mentor, consultant, or educator, someone who is going to be able to teach you how to get into the game, or teach you how to get deals done, right? Because there are many times in this space where I've had to call people, ask people questions to figure out, how to get past the next step. If I haven't, if I didn't do, what I'm trying to get done, right? So you definitely have to have that mentor, that person that you can reach out to, and sometimes you might have to pay money. And for me, when I look at that, when I try to take a look at, if it's paying for a mentorship versus just doing it by myself, I just say, like, I'm just charging it to the game, right? I'm just paying for my education instead of paying for mistakes, which are much more frustrating. All right, the second thing is equity investors. You got to have that capital tied up. I mean, that is very, 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 very crucial to you being successful. It's more, in my opinion, it's easier to be successful if you have the money lined up, as opposed to if you have the deal lined up. Because the thing in real estate, when they, when you first jump in, they say, oh, if you find a good deal, money would come. I think that's the biggest way to set yourself up for failure. If you think that you're just going to find a deal and the money is just going to come, especially when you're tying up larger transactions, then you have to put down 50, 60, 70, maybe $100,000 up front to start due diligence. You're in for you're in for a tough time there. So definitely know how to get your investors and where you're going to get your investors from. The third thing is the property management company. Absolutely knowing exactly who's going to manage that asset class, specifically tied to the criteria that you developed in step one. Super, super important there. You don't want a property manager that's managing C-class properties, managing a Class A properties. Two different management styles. The fourth thing is just your brokers, right? Figuring out exactly who are the brokers that are transacting in that market. And you can either go on LoopNet and do a broker search and figure out who those brokers are, call those brokers. And a lot of times, generally, it's either like 5 to 6 players within your market who are transacting all of the, or 90% of the deal flow, right? You might have a couple of residential agents that might come in and, get a commercial listing, but definitely figuring out who those real estate brokers are to funnel you deals. The mortgage brokers, right? Every time we're, like we're looking at a 29 unit right now, anytime that we are looking at a deal, we call up the broker to figure out, the mortgage brokers or your mortgage consultant or whatever the case may be. I call them up to figure out, what are the terms I can possibly get on this property. How are you guys sizing these deals? How are you guys looking at these deals in today's environment? What reserves do I need to potentially be looking at? Because you don't want to get into a situation, you're getting a property under contract and those costs are a little bit higher than what you anticipated. Your real estate attorney, right? Generally, every state has its own attorney that is licensed and able to practice within that specific state. So I can't have someone who is, licensed to practice in Maryland trying to do stuff in Georgia, unless there's some sort of reciprocity. But definitely have to have your real estate attorneys lined up. SEC attorneys, these are nationwide. I'm happy to refer you guys to, our SEC attorney, which is, they're pretty cost effective and streamlined in their processes, but definitely have to have that SEC attorney lined up for those transactions, those PPMs, if you're doing any syndication. Your contractors, most of you guys are probably already in real estate, so you guys already know how important contractors are to value add acquisitions. Your insurance broker, this is something that, I'm hearing from a lot of other operators that went to this local conference called NMHC, National Multifamily Housing Council. The big topic apparently was insurance, because as we already know, there's a bunch of disasters going on across the world. Things are happening. Insurance premiums are going up. Labor is going up. And so that insurance premium that your seller has today is not likely going to be your premium tomorrow, right? So definitely tapping into your insurance broker to talk about what the insurance policy might look like for this new acquisition, super important, because this is something that could change, thousands of dollars compared to the T12. Then the last thing is accounting and cost segregation. This is a study that, we perform on our properties that allows us to distribute depreciation to our investors. And this line item is something that I see a lot of investors under budgeting for, specifically because, for example, if you have, like 50 investors on a $10 million property, that's 50 separate K1s that you are distributing to your investors. So a lot of times, maybe a CPA might charge, CPA might charge, $75 for each K1 that they prepare. So if you just have one investors versus 50 investors, multiply 75 by 50, right? That's a total different number. So definitely have to have that accounted for in your operating expenses when you're looking at deals. Then the last thing here is just find the money before the deal. Find the money before the deal, and it's going to help you so much with having the confidence to close on these transactions. All right. The third step is just finding the deal, right? Deal finding strategies, right? Real estate brokers, we talked about that. That's probably going to be the best bang for your buck, because when you get into something like direct to seller marketing, obviously that comes with costs, writing letters, and there are services that automate this for you. But in my opinion, the better use of my time is allowing the brokers to give me the deals. And by doing that, it allows me to spend more time on actually building my business, whether it's raising capital from investors or just building those relationships to get more deals in our pipeline. It's all about how you want to set up your business, right? And also it reflects your deal finding strategy. So driving for dollars, some of us are already investors, so we already know about this situation. And networking and meetups, right? Deals happen in those networking sites and those meetups where you can just leverage relationships to find those deals, right? But I think the biggest takeaway from this slide here is that your deal finding strategy has to match up with your step one criteria, which has to also match up with what's available in your market. So for example, I'm in Baltimore City right now, right? There's not a lot of 200 unit, 300 unit properties in Baltimore City. So when I first started, I knew that I wanted to go big. I was trying to look for 200-300 unit properties, but the market did not support that. You might see a lot of that in Texas, but you're not going to see a ton of that within Baltimore City. So definitely figuring out, like, on a granular level, how you're going to approach these deal finance strategies, super, super important when it comes to not wasting your time and spinning your wheels. Okay, underwriting the deal, step number 4, right? So we found a deal, we defined the criteria. Now it's time to underwrite the deal, right? And all you really need to underwrite the deal is a T12 and a rent roll, right? And these are the 3 things that you typically want to see. It's the offering memorandum, someone from the broker who's giving you the information behind the deal, or the rent roll, which you're going to get from the broker or the seller as well, and the T12, right? And you're just going to package this up and also send it to your lender, and they're going to size the deal. And when I say size the deal, that's that's a fancy way of telling you, where they think interest rates are, where they think your LTV is going to be, et cetera, et cetera. Getting the terms, a soft quote, some sort of terms behind the deal that you're going to input into your spreadsheet. So for those who don't know, a T12 is just a trailing 12 P&L. Rent roll is just a list of what everyone is paying for that specific property. So if it's 10 units, you get 10 different cells or 10 different line items of what each person is paying for that property. The 4th thing is a market cap rate. Super, super important here, because the next one is sub-market cap rate. And when I'm looking at deals, I definitely want to know the market cap rate, but the sub-market cap rate is completely different, because you can be in a market that as a whole might have a higher cap rate, but because there's a ton of people migrating into a specific neighborhood, that sub-market cap rate might be in more demand. So that the market cap rate might be at 6%, but because there's a ton of people moving into one specific neighborhood and demand, that might drive the cap rate down to maybe a 5%. So you really have to dissect that and figure out, where your cap rates are going to be, because that's also going to be affected in your underwriting as well. The market vacancy, knowing exactly where things from a vacancy perspective within your market, that also correlates to your sub-market vacancy as well. So, as a whole, if the market is maybe soft, but as I mentioned, people might be moving into a specific neighborhood, that might be a stronger vacancy market, right? So all of these things here, I think, are equally important when it comes to putting together your underwriting and figuring out, how is this deal going to pencil? And really, it's just up to you to make those assumptions that you think are, somewhat conservative for your investors, right? Because in this market, we're talking about apartments. It's super, super competitive, but in order to win a deal, you also have to make assumptions that make sense and have somewhat empirical data to support that you'll be able to achieve that outcome. All right. So after you do that, right, you want to take a tour of the property, right? You want to take a look at things like the curb appeal to make sure that, your prospective tenants would feel welcome to your property. You want to take a look at the interior condition, property condition, right, which is pretty self-explanatory. Try to find some value add opportunities, whether it's, maybe just sprucing up the countertops, whether it's, doing something on the exterior, painting the facade, little things that people would, appreciate and enjoy. Maybe it's a dog park, taking an old playground that's, worn down and turning that into a dog park. If most of the tenants have dogs, little things like that are little value add opportunities that you can increase the rents for. I mentioned the exterior property condition, or I mentioned the exterior value add opportunities, but also taking a look at the condition is important there as well. The amenities, I mentioned the playground. Those are the little things that I think add value to your property and allow you to compete with your competitors, which is, based off of how you're going to value your rents as well, right, compared to the market. and just creating a deferred maintenance list, because all properties to some degree have some sort of deferred maintenance somewhere, right? But the ones that have a ton of deferred maintenance are obviously the ones to be looking out for. And so you definitely want to make sure that you have that, because you're going to go back into your underwriting and factor that in to maybe the reduction in cost or whatever you think makes sense for your offer. All right, so now after we did that, we're ready to submit our LOI, which is a letter of intent, and key terms we're going to talk about, right? The first thing is obviously price. The second thing is your earnest money deposit. Maybe that's 1 to 2% of the purchase price. Depends how competitive the market is. Your inspection terms. Typically, you're going to see a 30-day inspection window. I try to sneak in there 30 business days and hope that in hopes that the seller's attorney overlooks that. So if I sneak in like business days, I might get an extra 4 to 5 calendar days onto the contract. Financing terms in your term sheet, which is where you're going to take what you got from the lender and put that into your package. Basically letting the seller know that here are the terms that I'm actually going to finance the property under. I put in here the commission structure because you definitely do not want to include any sort of commission ask on your LOI. Typically brokers don't offer commission, but as an agent that wants to get into this space as well, you never ever want to touch the broker's commission, because 9 times out of 10 he's just not going to transact with you. The closing terms, typically you're going to see a 60-day window. Definitely consult with your lender on how long it's taking to actually close on properties in today's time. Like for example, in where I am in Baltimore City right now, it's taking a long time to get what we call lien certificates, right? So that's taking like 45 days to 60 days. So that's going to impact closing. So I think little things like that, when you talk to your title company and you talk to your lender, allows you to justify how long you intend to take to close on the property. Adding your real estate resume, super important here when it comes to credibility and track record. We've won deals in the past where we weren't the highest offer, but the fact that we, maybe owned properties near or have just transacted allowed us to win deals at a lower price. So your resume, super important when it comes to winning deals. And finally, the list of due diligence items, which I'm going to talk about towards the end, that you can download. It's also on my website for free as well. Your list of due diligence items that you're going to go with when you're evaluating the property, doing your inspections, etc., to make sure that it's financially feasible for you and or your investors. Okay. All right, so your LOI got accepted, right? So now it's time to negotiate the contract. Okay, so key contract terms here, right? Always use your real estate attorney for this. And, a lot of times investors try to, save on money, save on cost, but I'm a believer in doing things right, especially when I am raising capital from my investor base. They're trusting me to do right on their end, right? So you definitely want to make sure that you're using a real estate attorney. Okay. So the second thing is your letter of intent terms, right? You're just going to take those terms from your letter of intent and add that to your contract that you're using your real estate attorney for. The third thing is just your due diligence documents from the seller. This is a really, really important step right here, because a lot of times sellers try to forget, especially when it comes to a laundry list. Like our due diligence checklist is a laundry list of items. So when we're putting that on our contract, we expect to get every single one of those items, and it's up to us to waive any items if we feel like it's not quote unquote necessary for this transaction. That's really important there, because it allows you to buy extra time if your seller is slow. So if your seller is moving slow on getting the docs together, it essentially allows you to buy extra time within your due diligence period before you can waive, all items and officially tell the broker, hey, today is the day that I'm actually starting my 30-day due diligence period. So, it might sound a little, quote, not, I don't want to say shady, but at the end of the day, you want to put yourself in the best position possible to get as much due diligence documents as much as possible, and also have as much time as possible to evaluate this large property that you're buying. The fourth one is your inspection access terms, right? And this is just the terms that you're accessing the property under. Hey, I'm going to give you a 48-hour notice, 24-hour notice, because I might have a roofing guy that's going to walk the roofs to give me an estimate on, roof expenses, et cetera, or roof replacements. You want to have that open dialogue when it comes to inspections, because I've been in situations where, a broker would try to rush you through the unit because maybe they have something else that they have to do, or they maybe it's that awkward feeling when you're walking through another, someone else's apartment, and you don't want to like invade their space. But, how I look at it is, our investors are trusting us to walk the units and make sure that all units are accounted for, right? So you want to have a clear, you want to have a clear intention of how you're going to inspect these units. Definitely want to have those lender requirements in there, whether it's your property condition assessment, your environmental, your appraisal, et cetera, just so there's no, issues when you are, you actually get on the contract. You always have to have everything in writing. And then the security deposit terms, right? Especially with mom and pop owners, is that they don't really know. Like, for example, I'm referencing Baltimore City because this is our primary market. But in our market, we have like security deposit interest, right? So if you have 100 tenants that, all have security deposits, and you take over the property, well, when they leave, you're also responsible for their security deposit and the interest as well. So little things like that is something, are things that you really want to like engineer into your contract to make sure that you're protected, because if it's not coming out of the seller's pocket, it's going to come out of yours. And then always consult professional legal advice. Good advice pays you, right? So definitely want to make sure that you're spending the right amount of money for good advice. All right. So due diligence, right? We're going to talk about the due diligence process, and the biggest thing is just preparation is key, right? Definitely don't want to skimp on due diligence. Have a plan ahead of time. If you're, if you're looking at a large property and you're trying to do it by yourself, that's pretty challenging, right? Because you want to, on one phase, you want to, maybe take notes and take pictures, and it's challenging to focus on both when you are trying to evaluate, maybe 20, 40, 50 units by yourself, and also take pictures. So I also I just like to do, 2 at a time per unit, right? So if it's, maybe like a larger property, I like to have like 4 people, right? I don't know if, it could be your partners, it could be, your mom or your parents or whatever the case may be. The biggest thing here is you want to make sure that you're prepared. The financial due diligence, another great aspect of understanding the financial feasibility of a project, because your lender is going to be looking at the financial feasibility as well. I mean, commercial real estate depends on the financial analysis to come to some sort of value. So getting all of those documents from the seller that you're putting into the contract is extremely important when underwriting the property. The physical due diligence, I touched on it a little bit. You don't want to be scrambling on the day of due diligence, because you might try to set it up where you're walking the units, you and your partners are walking the units, and then you have a roofing person that's going to be, walking the roofs, or you might have an HVAC person, or a plumber that's looking at the boiler. And boilers are like $60,000, so it's like, you don't want to have that awkward situation where you are trying to walk units, take pictures, but then also pick up the phone to coordinate where to send your HVAC guys or your plumbers, et cetera. So you have to have that preparation and those coordinations processes lined up ahead of time. Another one is lender required inspections. This as I touched on a little bit earlier, this can be, your appraisal, your property condition assessment, your inspections that your lender might request, whatever structural inspection. So definitely want to make sure that you're aligned with that in due diligence. Secret shopping comps. So secret shopping, it sounds how it is, right? They do it in the retail space. Basically, we would go to nearby competition and just ask and just, fake and act like we're going to lease a unit and say, well, how much is this unit leasing for? Can you tour me a couple of your units, right? Because a lot of times what you see on apartments.com is just asking rents, right? Or they might, rents, they might make the change within the management for the rents internally, but not publish it on apartments.com. So getting that face-to-face interaction really gives you a feel of like what they're actually like charging for the units. And just your regulatory due diligence is another one. And that just comes to local, maybe code enforcement, or I've been in situations underwriting and looking at properties where it was like in a flood zone, and the local city they had an intention to take units off that were below grade, that were situated below grade because of environmental issues. Little things like that you want to pay attention to, because if they're taking units offline or something is happening at your property, that's obviously going to impact your ability to move forward as well. So do not skimp due diligence. Super, super important there. All right. So step 9, you're starting the financing period, right? After due diligence took about 3 days, you're starting the financing period, 30 to 45 days. Definitely want to get a head start on this as early as possible, because lenders can be slow. Investment committee can be slow. And so getting this started as quickly as possible would only allow you to have a smoother transaction, quite frankly. All right, so key financing items, right? Definitely your debt structure, knowing exactly how you're positioning your debt today, I think is very important in today's environment, because we keep hearing that a lot of people have this bridge loans and floating rate loans, and every time the Fed increases their interest rates, they're impacted, right? Their debt service goes up. So you want to make sure that you're putting on debt onto your property that can withstand economic turbulence. Understanding your lender cost as well is something that I think newer investors don't really have a good grasp behind, and that can be maybe application fees, whether it's your property reports as well, could be like 20,000. Maybe your loan commitment fee, that could be like another 0.5%. So little costs like that, these things add up, which are all risk capital. So if you don't close on a deal, you lose all of this money. Your property occupancy requirements. So typically, maybe you're doing an agency loan and they have this 90 for 90 clause, which requires you to have 90% occupancy for the last 90 days. And if you don't, then you're going to have trouble closing your loan. You don't want to run into this situation at all. Your debt service requirements, which is just basically, how many times over can your net cash flow cover the mortgage? Typically, lenders are going to want to see at least a 125, depending on the asset type and the market that you're in. So you want to make sure that the property is not falling into lower than that threshold. Key principal net worth. This is very, very important, because a lot of times if you're doing bigger deals, the lenders want to see a large amount of net worth, right? So you might have a partner that's interested in just lending their balance sheet towards the project or the partnership to secure the loan. It could be a non-recourse situation as well, where they're not personally guaranteeing the project unless there is some fraud attached to it. But you definitely want to know exactly who your key principals are when doing larger deals if you don't have the net worth for maybe a 50 unit building that's on the market for $10 million. Liquidity as well, they're definitely going to be looking at that. And this, the liquidity stuff, it varies depending on the type of product that you're putting on the deal. So just talking to your lender is something that you want to do ahead of time as well, to get that situated ahead of time so you don't have to scramble if you don't meet the liquidity requirements. Your renovation budget, which is pretty self-explanatory, right? You walk the property. We're investors. We know that things are required to get the property renovated. You might have some lender required reserves. Typically, on agency loans, they're going to want to see some sort of monthly deposits, or per unit for capital expenditures that might occur down the road. So maybe a roof needs to be replaced, etc. Some lenders are going to require some reserves put aside, depending on the risk of the property as well. Your insurance requirements, super important here, because you're going to talk to your insurance broker when it comes to putting on the property insurance, or maybe your lender wants to see something called I'm forgetting the name of it, but basically it's a situation where if the property burned down, your insurance company is going to build it back to the same code, right? It's called just left me again. But it's an important insurance requirement that you want to have on your property. So little things like that are things that you want to pay attention to. And that insurance clause was called ordinance of law. That's what it's called. Last thing, loan commitment. I mentioned the loan commitment fee. These are the small fees that, as you get deeper and deeper into the transaction, because all of this is risk capital, right? Your EMD, your inspections, your appraisal costs, your lender required inspection, whatever consultants that you're using, all those things are little fees that can add up. So you really want to know exactly what you're getting into when you're putting these properties under contract. All right, so we're getting towards the last two steps here, right? So if you're raising capital, this is another step, right? Because if you weren't raising capital, then you could just proceed to closing, right? So you want to prepare those investment docs, whether you're doing a joint venture, putting together an operating agreement between you and your partners, getting those LLC docs together, how your investors are going to be paid, whether it's an ACH deposit, wire, however you guys are doing those distributions. And then on the syndication side, which has a little bit more red tape, similar agreements from an operating agreement perspective, your corporate docs perspective, the private placement memorandum. Basically, it's a 100-page document that outlines all of the risk factors within the investment, and details about the investment. Your subscription agreement, which basically is a document that your investors are going to sign, basically saying that they're going to subscribe to your offering, and that essentially is their receipt for their investment into your project. And then from there, it's also getting that ACH deposit form of how you're going to distribute to your investors, the wire instructions as well. And I'm always going to say this: always consult professional legal advice, because when you're dealing with the SEC, or even just any sort of legal structure, America is the most litigious country. So you definitely want to make sure that you are talking to your legal professionals. And then step 11, right? We got all the way down to closing. We definitely have to make sure you have those takeover items set up, your operating account, right? This is where your rent is going to go into to pay those bills. It can be maybe your property manager is handling that, or your property manager is distributing funds to your account. So you internally, maybe you have your own accounting systems that you're going to pay the bills under. The security deposit account that's going to accrue interest that we talked about. Your capital expenditure account, which is basically going to be the account that maybe your lender is going to distribute the funds into maybe some reimbursement funds, or you had that capital that you raised that was set aside for a specific account that will be cutting checks to your vendors to do the value add. Tenant notices prior to closing, because a lot of times, when you close on properties, your tenant might, you might reach your tenant on the first of the month, and they say, well, I don't know, I didn't know that the property transferred, right? So a lot of times, a week before closing, we're posting notices. The day before, we're sending someone else to post a notice. Then when we close, we post another notice. So there's no reason why we shouldn't be getting rent on the first of the month with a good amount of notices. You might have some other local municipality notices of transfer of ownership. Financial reporting is another one, right? So if you're raising money from investors, they want to see reports. They want to know how your how their investment is operating, because they might be invested in different operators, right? So they might be comparing you to the next person, and they might say, well, you maybe seem like you don't really have everything going on right now. I'm going to continue to invest moving forward with someone else, right? Little things like that. I think the modern day investor is definitely paying attention to. Really, really important here, right, is the investor communication and business plan implementation. The reality is, things happen in real estate, right? It's always something going on in real estate. So I always like to say, it's easier to have that communication and talk to your investors up front if something is going on at your property, because bad news does not age well. So as soon as something happens, we communicate it to our investors. Even on the positive side of things, we would communicate it to our investors, because that's the type of communication that we want to have, right? And then the last thing is just business plan implementation, because if we can't implement our business plan, then we can't provide for our investors the returns that we said that we are. And if we can't do that, then they're probably not going to invest with us again, right? Because as real estate investors, especially if you're raising capital, the capital part is the lifeline of your business. If you're not able to get the capital, you can't close the deal. All right, so we've reached the end. This is the bonus section, the multifamily due diligence checklist. If you have not already downloaded this, we've had well over 10,000 downloads on this specific checklist. It's very intensive. Go to our website, merlinacquisitions.com, be a resources section. You can download the due diligence checklist, and happy to stick around for 5 to 10 minutes to talk about, any other questions that you might have within the multifamily space. Are there any questions? See some in the chat. Say Ash. Thank you, Ash. I appreciate the kind words. Feel free if anyone wants to come off mute to talk. I'm big on. Yeah, I'm happy to share a copy of the slides as well. If you want me to share it to you, just let me know, and our marketing manager will be sending out. We'll send you the slides. Just make a note here as to who wants the slides. Feel free to send an email as well. Any questions about anything that I went through?
Hey, Yanni, this is Lawrence.
Hey.
Hey, don't necessarily have any questions. Just wanted to say thank you. This was very, very informative. I don't really think I've seen or heard anyone just kind of walk through and break it down like this. So thank you. This is very insightful. And thank you for
Absolutely.
being the go-giver that you always are. So.
Absolutely.
So I have a quick question, Yannick. I don't have any experience in multifamily, and I have actually taken some online classes, and I was actually motivated by you mainly, but also have taken some good, helpful, online classes to learn underwriting. I was always very good with using spreadsheets. I'm actually an applied statistician in my research, and so it came naturally to me. And so I think I should I've done like 2 or 3, underwritings. Okay, but like you advised in one of your earlier units, just one of your earlier presentations, just find properties on LoopNet and start underwriting them, right? So I'm going to start doing that, very soon. But I wanted to understand, once I develop this skill, will that skill of underwriting enable me to persuade people like you and others in the multifamily investing space to have me as a as a general partner, if I'm ready to invest money as well.
Yeah, definitely. I think there are different factors to it. I think how I look at a general partnership team is like who is doing what, right? And what role are you adding to like the partnership, or would you be, maybe asset managing? Are you doing the construction management? Are you being a part of the group and also assisting us with raising capital for the project and doing the investor relations piece to it as well. So I think there are different phases that are within the life cycle of a multifamily investment, specifically what you're referring to in the syndication space. It just comes down to, where you want to fit. Because a lot of people, they might want to get their hands dirty and do the asset management and underwriting. And then they look up and it's just like, oh man, this is actually a lot of work. I enjoy maybe chasing the deals or raising capital for my investor base and going out and talking about real estate. And I've done all of those pieces, and I'm finding out which ones I really like and which ones I don't like. And so, from there, I would just find, different partners or bring on different partners that can, take me out of some roles that we're currently doing as well. So I think it just comes down to, where you fit within the team. But, as it relates to us specifically, would love to have that conversation offline. So.
Thank you.
All right. Chanidu, I think you had your hand raised.
Hey, what's up, Yannick? Yeah, can you hear me okay?
Yep.
I had a couple quick questions. I think the first one, so earlier you had mentioned, if I caught it correctly, like submitting your LOI after you've gotten your like financing put together. But are there any situations where you think it might be worthwhile to kind of like put your offer out there first, and then once it gets accepted, then begin the process to look at financing? Like, I feel like depending on who you talk to, you hear different recommendations of like which one has to happen first. So
I would say, with regards to larger multifamily, you definitely don't want to have a conversation with your financing before putting an LOI out. The reality is, because especially in this environment where rates are changing, it seems like every month, it's not a situation that you want to get into, because how I'm looking at the market today is that debt is the biggest risk factor at this point, right? The fundamentals are there. The demand is going to be there if you're in the right market, but the debt piece is making things super challenging. Specifically because there's a ton of capital on the sidelines that are looking for deals, that are submitting offers on deals just like we are, but the debt has increased, right? So it becomes much more challenging to compete with people that maybe have a lower return on capital requirement from their investor base, or what we're seeing is people are just buying properties all cash, right? And they're just saying, well, I'll sit on it, for 12 months and wait till the Fed starts to tick down a little bit and just refinance out of it, right? So I definitely won't recommend not talking to a lender, because things could just get so, fickle and change on you overnight. And you don't want to put a property, you don't want to submit an LOI on something that you can't move on. Because you're going to start building a bad reputation with that broker as well. So if we're submitting an LOI, either we're submitting an LOI with the intentions of closing on the property, or we're submitting an LOI that's lower than where we think we you know, than where we that's low enough to where it's not going to be accepted. And the reason
Right.
why I say that is because you don't want to get it when you're touring properties, and you spent a lot of time with a broker. You don't want to have that subconscious feeling within the broker that you're wasting their time. So I'm always constantly putting something in the broker to let them know, like, hey, I'm trying to win a deal. I'm trying to transact with you, right? And that's more receptive, I think, than, you know, spending a lot of time with the broker, asking a whole bunch of questions, touring the properties, and not just submitting anything, especially if you haven't transacted with that broker before. Little things like that, I think, build a relationship to whereas you can get in front of someone and actually win a deal. So I hope that was helpful advice on how I look at it.
No, it is. You actually touched on another question I was gonna ask. If I could sneak one more in there, which is about like how aggressive do you find that your like offer writing has become within a new environment? Like I think I'm running into like I'm like trying to go direct to seller to find opportunities. And I'm coming across some. So these are smaller, right? So it's not really brokers involved, maybe like local agents, just the owners themselves. But just given the asking prices, the numbers don't quite pencil out. And the debate is like, is it worth it to make an offer that though it feels aggressive to the seller, it's what makes sense given the underwriting? Or should you just like forego making it altogether? So I'm curious, like how aggressive some of your offer making has been in the new environment.
Yeah, so we're only as aggressive as we are confident on our execution part. So if we feel like we have the maybe a resources in an area that we can keep the cost down, which, you know, brings our offer price up, then we would, you know, in that situation we would quote unquote be aggressive on a property. But in that situation, you know, if you run into that, what I typically do is when I submit my LOI, I also submit a column of my underwriting, right? Or columns of a specific section in my underwriting that basically walks the broker through what I'm thinking on the property and why my offer is where it is today. And I think when you do that, you paint a different picture in a broker's head from being emotional when they see a number that they know that the seller isn't going to budge on versus less emotional and more you know, financially driven when you actually submit some support behind what you're offering. I felt that those conversations are a little bit softer when you submit that, you know, with an offer that is not what the broker was expecting or what they're trying to get for their client. Because the thing is, the broker is also pressured too, right? Because a lot of times brokers might take, I mean, I've been a you know, in the commercial real estate brokerage space before. They might take a listing knowing that they can't get the price, but they're being pressured by the seller because they might lose the listing if they can't sell the property. So
Right.
so it's like, you know, you want to, and that a lot of times your offer might help the broker convince the seller that the market isn't there compared to what he's asking for the property. So long answer to your short question is just submit your underwriting within your LOI, and that's a softer conversation as opposed to just submitting a lowball quote unquote offer compared to what they're asking.
Gotcha.
Yeah.
Yeah, I appreciate that, man.
And I agree with you on that wholeheartedly, because I found that once you submit your underwriting along with it and you show justification for your price, even though they don't like it, you might submit something like you said on two phases. One, the broker could show that he's actually trying to make traction to sell it. The second part is he might find out he overlooked things himself that he did not realize when he was putting the property out. And by you submitting your underwriting to him, he now can see other things and realize this is going to affect the price on the end. So this is not first or the last person is probably going to submit to me a price like that. So I appreciate your candor and your passion on your knowledge, because I found that out firsthand on there. So I don't even worry about submitting LOA because it's low. I just submit them. I mean, unless you're doing something totally ridiculous and you can't justify it, then that's something else. But I agree with you. Just submit it. Just
Yeah.
because sometimes you might be surprised. I had them circle back around to me because they couldn't. It fell through or whatever on there. But long as, like you said, and that's the part I want to stress, is the candor that you're being upfront, because I experienced it firsthand what you just stated to us, and it really is. So I appreciate that. Thank you.
Absolutely. Absolutely. Thank you for your wisdom. All right. Well, I hope that this presentation was helpful, and I think this is a good step for anyone that's trying to get their first deal done. Definitely, if you have any questions, feel free to send an email. My email is here on the slide, and I will see you guys next time for the next webinar. So thank you.
Absolutely. Thank you, man. Have a great day.
You too. Thanks.
Thanks a lot, Yannick.
Appreciate you.
No problem. Thank you.